Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast.
Hugh, welcome to the podcast, mate.
Thanks for having me, Owen.
I think this is our first in-person recording.
It is. I'm super excited to be here. I mean, the last time we spoke was online through the podcast on YouTube last year. So
here we are in the
flesh.
Here we
are in the flesh.
This is not an AI simulation. That's maybe a question for a few years' time. But we are going to talk about AI. We're going to talk about technology, 2025, the year that was, the uncertainty with US President Trump back in office, what that means to investors and how we can get comfortable still investing after a huge year for the stock market in 2024. I guess 2024 is a good place to start. It was the US share market up 30% or more, right? How do you think about the year that was? And for any investors that are listening to this that are thinking, maybe that's normal, how do you then translate some of that going forward?
Yeah, I mean, as everyone knows, 2024 was a really, really good year for investors. Like the US equity markets, both the S&P 500 and the NASDAQ, they were both over 25% in total return terms. Now, that follows a period in 2023 where equity markets were also up over 20%. And, always investors are asking, what is the driver of that? And I think there are probably three key reasons. The first one is probably on, the economic backdrop. In late 2023, markets were focused on a soft landing scenario. And just for your listeners or your viewers, what that essentially means is that you're getting a good economic outcome through falling inflation and generally low unemployment. And we really saw that play out. That sort of achievement of the soft landing scenario, that was really good for risk assets such as US equities. And we also saw interest rates start to fall over 2024. I think the second point beyond just the economy was corporate earnings. Corporate earnings were still very strong. The Magnificent Seven, generated returns, year on year and quarter on quarter. And thirdly, I think the final thing is that the US equity market was probably the only place where investors could really, see good returns. And what I mean by that was we saw a lot of geopolitical sort of quagmire across developing nations. You had sort of issues with South Korea's president, raising martial laws in that country. And also France and Germany had a little bit of political upheaval as well. And you had just generally uncertain conditions in countries outside of the US. So I think all three factors probably, explain why 2024 was a good year. And it wasn't just US equities, like other asset classes performed quite well, like gold and Bitcoin. They actually outperformed US equities. So I think those are probably three key factors that help explain the year it was.
All right, Hugh. So really good answer, really thorough. If you were, so we're now sitting here early 2025, right? That's the couple of years that were. And a lot of our community, maybe they're newer investors, maybe they're seasoned investors. Like I spoke to one investor yesterday who's been investing for 7 or 8 years himself. And he is really concerned, right? Because he's like, well, this just happened overseas. It was a really strong year. There's a lot of stuff I don't understand. And here we are sitting at the beginning of 2025 and people are starting to get back into investing. Where are we right now?
Yeah. We are in a very well-priced market. And what I mean by that is, it seems like, US equity markets and equity markets in general have continued to rise and rise. So we're almost priced for perfection, but I still think there are still a lot of positives. And, we as humans can often, over-exaggerate, negative news or negative impacts. I think that, there's still a lot to be positive about, just generally in investing. Corporates are still, earning, lots of money and profits, but there's probably more of a role to diversify portfolios beyond just the US. So we can talk about, different opportunities that investors can explore. And then, we've also had news of DeepSeek come out last week and what that might potentially mean for markets. Nvidia fell about 17% just on that news alone. But, I think overall net positive, DeepSeek is good for the technology sector, because when you're reducing the cost of AI, that's ultimately a deflationary trend. And that's what we wanted to see after periods of high inflation. And so, I think the markets, there's still a lot to run from here, but it's probably well worthy to take a more diversified approach and be a bit more aware of risk management as well.
So just for anyone that's new to this podcast, when Hugh says equities, he means shares?
Yes, that's right.
Yeah. Just to cover off that base. So US shares. So people will be familiar, like you mentioned DeepSeek, which is an AI tool for people that aren't familiar with it. You go to the website, you can check out, they do side-by-side comparisons with, ChatGPT or OpenAI, Google's Gemini, Llama from Meta, Claude from Anthropic. So there's like all these different AI tools that are like leading the world, and DeepSeek is the first, as far as I'm aware, like the first big Chinese instance, if you will, of that coming to market.
Yes.
But what's happened over the last few years, Hugh, is what you alluded to, is that a lot of the stock market's return has come from those mega tech companies. Even Tesla will throw in there, Nvidia, you mentioned, which makes the chips, Microsoft, Apple, these names. You mentioned diversification. Do you mean also, like, as people look out this year and beyond, is not just those names, but other things?
Yes, not just those names, but other things as well. Yeah. So, we're talking about, sectors outside of, the technology industry. We're thinking about, financials and industrials. Trump has come into office in 2025 and has been very sort of pro-business and very light on regulation. So that should support a lot of the industries within America, such as, financials, industries, even the auto sector as well. And so, we have a fund that has that sort of exposure to those sectors. It's the Betashares S&P 500 Equal Weight ETF, which is the ASX code is QUS. So what it does is it literally has an equal weight of each of those 500 stocks. So you get 0.2% in each stock. And because it does that, it will sort of rebalance your sector weight. Say you had, shares in the US, stock market like the NASDAQ 100 or S&P 500. They're typically skewed towards the information technology sector because the Magnificent Seven stocks have such a high weighting to it.
Yep.
And so QUS has a really nice component to it where you're getting broader representation of the US economy, particularly to the banks and industrials as well. So, it's done, pretty well in terms of, inflows into the fund. It's around $760 million.
So, wow. Okay.
And it's fairly priced as well. So
that could be a good way then, because like with the Betashares NDQ ETF, which is like I would say the flagship, like it's most popular, it's the NASDAQ 100. So you got like the big names in there.
Yes.
But then you could almost blend it with QUS as well. Right?
Absolutely. Yeah. It's a really good point, Owen. So we've actually done some analysis on what it would look like to blend a portfolio of NDQ and QUS. If you just took a naive sort of 50-50 blend, it showed that you could retain a lot of that outperformance over, say, a global MSCI World benchmark, whilst reducing some level of volatility. We've seen that typically, when the NASDAQ or NDQ ETF rises, the equal weight ETF will sort of underperform and vice versa as well. So the risk adjusted returns, or the returns accounting for the level of risk, actually rises up.
So it's actually better with the two together.
Exactly right. So it might be a sensible approach for some investors to blend some QUS with the existing NDQ ETF as well. So it's a really good point you bring up, Owen.
Yeah, right. Okay, no, I didn't even think about that. I didn't know you were going to talk about QUS, so that makes a lot of sense. So a lot of your role, like you've obviously got like the finance pedigree, you've got all the experience across that aspect, but you love technology companies, you love just everything about it. One of the things that so I've been doing this for a long time here, as you know, not just the podcast, but investing generally. And I feel like I would look back when I started investing at like the people who were around in the 90s thinking about like the dot-com era when websites all of a sudden became a thing, Amazon was a thing, Netflix was a thing, like all these interesting companies emerged. And sure, like since then we went to mobile and all that. That was fun. But I feel like we're at this kind of stage in investing and in the world where we've got this new thing, which is AI. And I don't want to be like full buzzwordy in this podcast, but I feel like that's something that I can be excited about because I genuinely am. How are you thinking about like this year and the opportunities, not just for this year, but like the big trends that are emerging throughout markets 2025 and beyond?
Yeah, I mean, it's such a big question that we can unpack. Like, I guess starting with AI, how I see that sort of playing out in 2025 is probably we're starting to see the markets focus more on the application and workforce layer. And what I just mean by that is think of an end user like yourself and myself. We have an Apple iPhone. Apple Intelligence is sort of their AI feature, which is embedding AI software into your phone. So that helps to increase your productivity and whatnot. And so, we talked about DeepSeek a bit earlier before and the implications of that for markets going forward. It essentially will allow AI to be, commoditized and become more of a good for most people. And because of that, more enterprises, businesses can create different software applications for, everyone like us can enjoy. So I think markets will pay a bit more attention to the software layer or aspect of AI. And we saw that with earnings, Meta reported earnings yesterday and they traded about 5% higher in after hours trading. And Apple also reported earnings overnight today. And they also traded a bit higher because their services unit grew, quite fast, even though their iPhone or the sales fell just a little bit. So you can see that sort of hardware versus software dynamic playing out within AI. And I think that we'll continue to see that. So, companies like Salesforce, Meta might benefit, this year.
Yeah, I feel like we're actually, the funny thing is we're in the Salesforce building right now, right? Yeah. So I saw a few Salesforce people on the way up. And it's interesting because I feel like that's kind of a secret that people probably don't really understand is like, it's all well and good to have a tool, but you kind of need nails to hit. And like, if you've got the data, like on your business, like if you're a tech company and you're looking around, like, what can we do with all this data? All of a sudden you've got this AI thing walk into the room and be like, well, I can analyze all of that for you in like 5 seconds. Let me help you with that. Yeah. And it's like, that could unlock a lot.
Yeah, absolutely. Like even in my role and doing research, there've been a influx of different AI models where it can assist you with doing research. Say, you're looking to research a particular topic, that AI bot might give you a few sources to go to instead of using a typical Google search and having to scroll through the internet. Using those chatbots or sort of AI models can be, quite helpful even in a investment strategy role like the one I'm in. Yeah. So it's been really good.
Yeah. How about in terms of other themes? Like, obviously, there are big economic and political themes that are going on right now, but even just within like sectors or industries, are there things that you're looking at this year and beyond?
Yeah, there's a lot of other themes that we're looking at. So cybersecurity is probably another one. And the reason why I say this is because you've mentioned previously that we're seeing a lot of geopolitical sort of tension between various nations, the US and China. There's a lot of tension in the Middle East, Russia, Ukraine. I could go on and on and on. And the implications of that means that the possibility of bad actors hacking different systems will also increase. And we've actually saw that with China hacking AT&T. So they had a group called Salt Typhoon, which is a very sophisticated Chinese state-based actor. They infiltrated AT&T's database. Wow. And so that's just one example of many out there. Spending overall within the sectors, probably forecast to exceed $260 billion, according to Morgan Stanley. So we're seeing a huge amount of money going into the sector as well. And another key sort of unique characteristic of cybersecurity is that when you think about other segments of the market, cybersecurity is probably one of those most defensible areas within technology and software. And what I mean by defensible is, say you're you're the chief investment technology officer at a firm. Yeah. And you're looking across your budget and you need to see, okay, am I going to cut, cybersecurity spending? Probably not.
Yeah.
Relative to other software services. And because you want to ensure that your data is protected as we enter an increasingly fragmented geopolitical world. So, in terms of the growth prospects, we're seeing very strong structural thematics pushing the sector up and up. But we're also seeing, corporates not pulling away from any funding needs, even in an environment where they might need cash. So,
that makes sense.
cybersecurity has been a really big theme. As well. And also, by extension, I would say defense. We have a global defense ETF that we recently launched as well. The ticker is ARMR or ARMR. And so, that has a portfolio of, global, defense companies like Rheinmetall, Lockheed Martin, etc. And, under the Trump administration, they're putting a lot of pressure on European sort of nations to increase their defense spending budgets in order to alleviate the Russia-Ukraine sort of war. They want them to spend at least 2% of their GDP on defense spending. And so again, there's a big amount of spending happening within the defense sector. And that should benefit, funds, like ARMR. So.
Yeah. And Hack, which is their super popular ETF, cybersecurity ETF. It's kind of crazy when we talk about these numbers, like on a podcast like this. It's kind of like people are like, yeah, cool. That's all amazing. But what does it mean? It means that like anyone watching this or listening to this can be like, I see what Hugh's talking about. The future is obviously here. I can use an ETF to scoop up that entire industry in one trade, which is very unique. Whereas like 15 years ago, you'd go through and like try and identify which stock's going to win. You might get it wrong. You might lose a lot of money. But now you're like, I can just buy a basket of shares, like all in one ETF, and it gives me that stuff in one go. And I think that's like these three industries which you mentioned. Probably defense is more something that's been pushed to the fore recently, but those first two are huge, and they kind of pair. It's like wine and cheese. It's like AI spending also means more cybersecurity, which probably means more AI spending.
Yes.
And it's just like they're both just, floating off into the distance. How about then, are there any other ETFs that you think, like from your range? Because like obviously Betashares is sponsor of the show, right? But I'm one of these people that if you're here to talk about ETFs, I want you to tell me about the ETFs because you've got them in front of you.
Yeah.
Like, is there anything else that you would say, or any other ETFs or funds that people can go and research after listening to this?
Yeah.
That you would be like, hey, put these on your watch list, kind of thing.
Yeah. So I talked about it a little bit before, but maybe I'll sort of reiterate what we said. So we had NDQ. I think many people are aware of that fund, the NASDAQ 100 ETF, but QUS has been that other up and coming ETF because of the sort of tailwinds behind a broadening out of US equity performance or US share performance. So the ticker was QUS, or the Betashares S&P 500 equal weight ETF. I think investors, should probably research that a bit more. Again, you're still getting access to the S&P 500. But it's, trading a little bit cheaper than some of your market cap weighted indices, and then also earnings are sort of expected to grow, around 13% over the year. So it's a really good fund from that perspective. Other funds, as we mentioned, Hack was a global cybersecurity ETF as well. ARMR is another one. We also have a couple other NASDAQ sort of ETFs within the suite. We have JNDQ, which is the NASDAQ Next Gen 100 ETF. That might be an ETF that not many of your listeners may or may not know. So what it is, it takes the largest 100 companies outside of the NASDAQ 100. So think of the 100 to 200th company. The idea is that you want to be invested in the up and coming companies with innovative technologies that are riding up the market cap spectrum, or, in layman's terms, getting bigger in size. And so, Next Gen is another ETF that we have, and also QNDQ as well. That's an equal weighted NASDAQ 100. So there are different ways for investors to be invested in the US stock market or the NASDAQ 100. And so, if they're interested in other ways to explore the NASDAQ, JNDQ and QNDQ are also very popular sort of ETFs.
With QUS, I want to really hit this home for people because, like, say, for example, say like a massive technology company like Facebook or Google or something like that. After COVID, people may remember that they let go of so many employees. It was crazy how many software engineers, they were like, we just don't need this many. After like the kind of the rush out of COVID and then back down, they were like 50,000 people would just be let go, right? It was crazy. And what that showed me is that in technology companies and in technology broadly, is you really only need like the best and the brightest. But what AI has kind of taught me more recently, Hugh, is that you may not even need all of the best and brightest. You just need some and the AI to work with them. And so what I mean by that, it's kind of like democratized software development. It's democratized. Like if you're a small business and you're like, I don't understand how to build a website, you can jump into this thing and say, hey, help me build a website. And it will help you, coach you through it and help you do the stuff, right? And what I mean by that is like, you mentioned broadening out. So you're not just investing in Apple, Google, these types of things, or Microsoft, which has a big stake in OpenAI. But you're getting the crop of companies that are great businesses, but are also now supercharging themselves because of what someone else has built. And I feel like that's the kind of that middle ground. I think about that a lot.
Yeah.
Not just over in the US, but also here in Australia.
Yeah. No, absolutely. I think it's a really good point. You're starting to see, AI becoming a productivity tool, not just for white collar people, but also people within, the industrial sector as well. Like, building, cars, etc. That could help that sort of process speed up. We haven't seen that sort of process happen yet, but over the years and decades, that will probably flow through to other sectors. So you're absolutely right. QUS or the broader US stock market could benefit from a AI productivity boom. And we saw that, over the last week with developments in China as well.
Yeah.
Also, the Trump sort of effect of being America first and pro-business and deregulating a lot of those red tape around industries like the banks, that should be very supportive for, corporate earnings to continue growing forward. So that's why QUS is a really, really great fund that we as a house sort of favorite at Betashares. It's something that I'm great talking about.
And we should mention though, for anyone that's like maybe unsure, we're not talking about like the stock market just all of a sudden rallying for no reason or just for AI. It's a long-term thing, and we're talking about the businesses and the industries. In the short term, the stock market can do literally anything, and that's important to remember. I want people to be excited about the future of investing because I think, Hugh, that if you are a long-term investor, by definition, you are optimistic because otherwise just put your money under your pillow or just buried in the backyard. But if you are investing, it means you're betting on a brighter future. And I think right now is a really interesting time. So let's talk more about this risk because I've got this in my notes to talk to you about. People will be saying, yeah, well, this is all well and good, but what about if the market crashes? Like, how do you think, like people are saying it, I'm hearing it every day in the media, is like the US stock market is expensive. Like even they're saying that about Australian shares. They're saying about basically everything all the time. How do you think about that?
It's a great question. And I want to address that on this podcast and talk. The biggest concern by large and far is concentration risk and valuation risk. I would say if you are of the belief that the stock market is expensive and you don't feel comfortable investing in a very top-heavy market, then something like an equal-weighted approach can help justify or give you an avenue to still access the US story, but at much cheaper levels, and you're still getting the same earnings profile as a market cap index. And what I mean by earnings profile is, you are still getting access to the same companies and the same stream of revenues that they expected to earn over 5, 10, 15 years. So for example, the market cap S&P 500 is trading at around 22 times forward PE. That is the price, the current price divided by the forward earnings expected over the next 12 months. The QUS or the equal weighted ETF is trading at around 17 times. So that's around 22 to 25% cheaper, but you're still getting access to the US exceptionalism story. And so, to answer your point, yes, there are definitely risks in the market, but there are other ways to be invested or still play that theme. Just because, you might see, one provider giving you a market cap ETF or indice, that doesn't mean that there are other alternatives as well. A very simple equal weighted approach can really address that concern. Now, if you're an investor that thinks, well, these valuations are justified, concentration is justified because these are the best companies in the world. They're the most innovative. They have dominated because they have such a big moat compared to other businesses out there. So they are justified. In that scenario, you could still be invested in the NASDAQ 100 or S&P 500, but it might be worth considering, geographically diversifying your portfolio and also from a sector perspective as well. So considering regions, such as India. India's a really good country where that might benefit under, a Trump regime because they're not as exposed to tariffs on goods. They're more of a services export nation, so they won't be hit as hard as China and Europe. And yeah, there are definitely other regions to explore there. And also taking a diversified approach to investing. I'm sure we all know the importance of that. Making sure you're not all in one sector or one ETF. Having a nice, sort of broad balance between regions, countries, styles as well is another factor. And if you can sort of take that nice balanced approach, I think that 2025 can still be a really great year for you, and you can ride any volatility in markets that we might see. And I think that with Trump under office, we can all agree that volatility may increase from here. We don't know. There's a lot of back and forth with his policies as well. Yesterday we saw the Fed in the US take a bit of a wait and see approach as well. So markets are, a bit jittery right now with, the AI developments, earnings coming out, the Fed, deciding to leave rates unchanged. And so, I think just taking, a balanced approach across sectors, countries, styles, nations as well, 2025 should still reward you. The economy is still doing very well. Interest rates are still going to fall down, and the economy will still continue to grow, the global economy. So I think it's important to remain consistent, invested. As you said, Owen, if you're thinking about investing, you probably should take a long-term approach. You're leaving your money in for some time when you are considering shares.
Yeah. I always think that money has to go somewhere. So that's why we talk about portfolios. So people sometimes get confused. They're like, well, I read this thing in the news that said markets are expensive. My kind of knee-jerk reaction is that, well, what are you going to do about it? Like, what are you going to put? Are you going to put money in the bank or in a property, or where's it going to go? So it's all about portfolio and kind of it's not all or nothing. I think that's when beginners make mistakes. Is they think it's I'm either invested or I'm not, but no, it's shades of that. Well, it's just not as much. So maybe if you do have NDQ and you're a little bit worried about tech companies, you blend that, as you said, or you go to India, or you go to Australia, or you do whatever. But just keeping some investment is really important in my opinion. Absolutely. Because you could be wrong. Yeah. And shares keep going up, right? So I've got a few more, just a couple of quick questions here on the NDQ. Obviously, now we want everyone to go away and read the product disclosure statements, or the PDSs. So that's the critical legal document that goes with every ETF, and it's all available on the Betashares website. And I'll put a link into anything that you do mention. But if people are listening to this and they're like, okay, you guys are talking about these big things, I'm kind of excited about investing. I know there's some risks. If you could maybe just say, so you've said QUS, maybe that's one, but if someone was listening to this and there's another ETF that you would say, pop that on your watch list, go read, we've got some articles on the website, I can link to those as well. What would it be? I
would say YMAX is another
YMAX.
One. I think that, we can talk about, this further, but YMAX is it's a unique strategy. It is a covered call strategy on the ASX top 20 stocks. And so what it does is it essentially sells what we call call options. Now it's a form of derivative, and what it does is it enhances your income. When you sell an option, you can generate a premium, and that flows through to an investor. The reason why I say that is because considering this as a technology sort of chat, moving on to Australian stock market and equities, we've really seen, again, a very similar story in the Australian equity market. The top sort of 20 stocks are becoming increasingly bigger and bigger.
Like Commonwealth Bank.
Yeah, like Commonwealth Bank and BHP. And we're also seeing the dividend yield start to fall. Recently, I checked on Bloomberg, the dividend yield for the ASX 200 is just 3.6%. Like that's a very, very low amount. And we know that a lot of Australians rely on income, particularly from Australian shares, because you get franking credits attached to that as well. But at 3.5%, I mean, even if you add on franking credits, that will add in an additional 1%. You're getting to around 4.567. TD rates can probably give you the same.
Yeah.
And so, YMAX gives you exposure to the Australian equity market. And if you're an investor where you have the belief that there is further potential for the Australian stock market to continue going higher and higher, but you still have a reliance for income as well, then YMAX might be a really good and interesting ETF to consider. So maybe that's one for your listeners to research.
Yeah. So we've got QUS, which is the equal weight, and then YMAX, YMAX. I'll put links in the show notes to both of those so people can get started. Okay, so I've got two quick questions on the end. We've covered a lot, right? I'm asking you for like, if people are looking for like something else, so not like an investment, but more like something that they should focus on if they're just getting started this year, perhaps. What is the thing that they should focus on? It could be behavioral. It could be a resource. It could be like, hey, go read this book. It could be just one tip, like in a positive direction. Because then I'm going to ask you the opposite. Like, what shouldn't they do?
Yeah.
This is what should they do?
Yeah. Listen to Rask.
Yeah, okay, man.
Tune into podcasts.
Yeah.
I actually, and saying that in a positive way, because podcasts and this sort of media is democratizing financial education. Before, we never really had this sort of medium in order for people like myself broadcasting our thoughts and content to people like you, Owen. And so I think just tuning into a podcast and just listening to other people. I might have a view on technology that might be different to someone else that you might talk to, Owen. And so a listener might be like, okay, well, Hugh said this, but Tom said X, Y, Z. What are my thoughts on that? And so when you start listening to more and more people, then you can start forming a view on where other people are thinking at, and then you can start forming your own conclusions as well. But I think reading a lot in general, in combination with podcasts and multimedia, is important. For example, I read the AFR every day. I read Bloomberg, and I think those are really good sort of points really just to start off with for a beginner. Just seeing what's happening in markets, and then you might be typing into your Spotify account, AI or DeepSeek or NASDAQ 100. And I'm sure you might see a Betashares conversation with Owen Rask and Hugh Lam pop up. And that's how you, start that rabbit hole of investing. And then you read more, you listen more, and then, you start forming your own thoughts about markets, and you can begin investing yourself.
I think that once people have that seed of curiosity planted, it just goes in. It
just keeps going and going. Yeah.
And it's great because you become. Tony Robbins wrote about this in his book where he said the money game or something like that. He's one of his first money books. He said like you don't just become a consumer in the economy, but you become an owner of the economy. So what we're saying is don't just sit there and let AI do its thing without you investing in it and making money from it. Because you have that opportunity right now. I'd add to that the Betashares website, you guys. It's known in the industry of finance and investing that the Betashares team is the leader in content and all that sort of stuff. So there's heaps of things on there. Final question then. We'll go counterpoint. If that's what they should do, everyone that's listening to this or watching this, what should they avoid?
I think people should avoid hot tips. If there's someone, I'm not, digging into anyone on TikTok, but typically you might see if influencers on TikTok have 20-second videos saying to buy Bitcoin because it's going to go up 100% next year. It might be a bit too good to be true. So any sort of, videos or that might seem like a gimmick or promising you returns that are like too excessive, you might want to avoid. And also, try avoiding putting all your eggs in one basket. Comes back to the point of diversifying. Already an ETF can give you so much diversification already because there's so many different shares within that basket, but you can become concentrated within one ETF. You know, say you pick, a certain thematic ETF, you might be exposed to changes within that sector or thematic. So you do need to be careful as to what ETF you're investing in. I think that investors should take a very diligent approach to selecting ETFs, just the same way that a stock researcher might select a stock. I think there still needs to be very deep research when it comes into picking an ETF as well. So that's probably two things I suggest investors avoid.
Yeah. So it's more like be mindful of the content that you do consume, which is the first part, and then also on the other side is like just try and recognize over time what is too good to be true. And I find that's particularly pronounced in people's social media feeds, because you tend to follow people that you like, and therefore you're more likely to agree with them. And if they come out with something wild that has no basis, you're more likely to agree with it just because you like them. And so it's used to be really mindful of that, and obviously diversification.
Yeah, I mean, the benefit of an ETF is that all the holdings of the ETF is very transparent, so you can see exactly what stocks you're invested in, and that can help with building a well-diversified approach to investing. You might have a couple ETFs that might be holding the same stock, and then you might be thinking, well, does it make sense for me to add that ETF when I already have holdings in my other ETF? So, it's another really good benefit of an ETF.
Yeah, cool. Well, Hugh, I'll put a link in the show notes to you on the Betashares website. We'll link through to QUS and YMAX in particular, but all of the funds are available on the Betashares website, as well as a load of content. You can subscribe to the newsletters. You can get David's weekly email about the economic situation. It's awesome. That's the one that I read, to be honest.
Great.
So that's all available in the show notes, mate. This has been great to do in person. So
absolutely.
Thanks for joining me.
Thanks, Owen. Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.